Yes, I've been, I have about just over 17 years of experience in the financial markets, having started off as an investment banker and then moving on to mainstream banking, but specializing in fixed income and money market. So I believe we are here to learn, maybe to learn from each other, to interact, and so I don't know whether you'll moderate about the presentation. It's a short presentation, and then we can move on to Q&A, if that's okay with you.
Yeah, that's fine, Akiyama. Yeah, just give the directions and I'm here to assist you. So I think we can get started. To our viewers, karibuni sana.
Yes, so basically, even as we focus on treasury boards, it's good to appreciate the fact that T-bills and T-bonds are almost mentioned in the same breath. So I thought we might also need to highlight something about T-bills, maybe later in the presentation. But to start off with, I wanted us to maybe look at what a board is, given that I had seen some people asking about corporate boards and treasury boards. We can also touch on that. So to get us started, we can go to slide number 3, where we talk about what a board is. The next one. So basically, a board is a financial instrument that pays the investor a regular income or cash flow for the period of investment. In financial terms, this is basically referred to as a tenor. And for treasury, for boards, we have two types of boards. There is the treasury boards and the corporate boards. Corporate boards are issued by private companies to meet their financing needs, while treasury boards are issued by governments to meet financing gaps. For treasury boards, they are mostly regarded as risk-free, and this is because they are backed by government. The government guarantees the issuance, and therefore the risk of default is near zero. Corporate, on the other hand, issued by corporates, limited companies, and therefore, as with the law, or maybe we can look at a few companies that have previously issued the corporate boards, and then they have gone, bankrupt or gone down. The investor is left exposed because now the terms of recourse are a bit limited. So in our market, T-boards are characterized by regular interest payments. This is semi-annual. And what I mean by semi-annual is the interest is paid twice a year. That's twice in 12 months period. Ideally, the longer the term or the tenor of the board, then the higher the expected return in terms of coupon. And this is well depicted when we look at what we call the securities yield curve, which is ideally supposed to be upward sloping. But in periods of maybe liquidity constraints, or when we are experiencing some inflationary pressure, you find that the curve may be inverted. And by the curve, I mean its relationship between time and the interest rates of the various maturity tenors for financial instruments. So like currently you find the short-term rates, they're a bit elevated compared to the long term. And therefore you find that if you are to plot a chart, On the left-hand side being the short term moving towards the right, you'll see that the rates are a bit downward sloping as opposed to upward sloping. We can move to the next slide. So the relationship between interest and prices for treasury bonds is inverse, meaning that whenever the interest rates are rising, then the prices of the bonds decline. Case in point, like if we look at the bonds that had been issued last year or maybe 2 years ago, when the rates were in the levels of, the short-term rates were sub 10%, we see that those prices now, because the interest rates now for the short term are above 15%, you see that the prices now have gone in the opposite direction. But there are various strategies that investors can use, which we'll be looking at later, which can mitigate those risks. Just to mention, for investment in treasury bonds, one is required to have a CSD account at the central bank, which now can be opened online through the DAO CSD. Yes, thank you. Through the DAO CSD app, or you can access the same through the website, CSD portal. And all you need to have ready is your copy of ID, PIN certificate, and a photo. Then once you log into, it's a very simple process, a few stages where you fill your details, attach your documents, and then you submit to go to your commercial bank for approval. And once that is approved, you're given an account number, just the same way you would get a bank account number in a commercial bank. And that's the one you use to invest or to buy T-bills and T-bonds. One can open the account either singly, jointly, as a chama, as long as it's registered, or even as a limited company. The process, like I said, is pretty much easy, and there is the CSD account opening guide published by the central bank on their website. Maybe if we get questions, I think people can interject and seek clarity and so on. Let's move on to the next slide, because I think it's good, even as the next one, we talk about T-bonds. What usually happens is whenever central bank, yes, where we were, whenever central bank is issuing a bond, they usually issue what they call a treasury bond prospectus. A prospectus basically is the terms of the bond or the financial instrument that is being offered. And I thought it would be good if we took a sample of them and go through just to deconstruct it and maybe put meaning to some of the terms that have been put on that document. And to start with, we see like I want to start from the tenor, because the first three, that is on the left, we have the issuer, amount, and purpose. I think those ones are pretty much straightforward. But if you look at the tenor, for example, this is a bond that was 6.5 years. That's what they refer as to tenor that was being offered. If you look at that, you can see the period of sale. The period of sale refers to the time that investors are given to submit their applications to the central bank for that particular security. The value date is the payment date, yeah, which also you can see that those are semantics, because value date and payment date are the same. This is a period where the investor is required to pay for their successful bid, yeah. The price quote, you can see there it's written discounted premium or par. So what that means all treasury securities in Kenya are broken down or priced into units of 100. So for example, if an investor is investing 50,000 Kenya shilling, so those ones are broken down into units of 100, which means it would be 500 units. So in terms of pricing, you price it on basis of 100. If it's a discounted, and this is after the auction has been done, then what that means is that you'd end up paying less than 100 for every 100 that you want to buy. If it's at a premium, then it means you're paying more than 100 for every 100. At par, it means you're paying 100 for every 100 you want to buy. Now, to also go further and construct that, what they mean by a discounted security is if we were to take the case of any auction, maybe we are auctioning household items. Take, for example, the case of a TV set that is worth 100,000 shillings. If everyone can hear me? I see a message like my network is breaking. Gertrude, maybe you can confirm.
I can hear you clearly. If you can hear our speaker well, kindly raise your hand so that we can see what we need to do. However, don't worry, the session is being recorded and I'll share the recording after this session, so don't worry. However, on my end, you are clear. Yeah, I can hear you well.
Okay, so let's continue. So I was giving the example of a TV set worth 100,000 and it's being auctioned. So you find that people will quote, maybe there's someone who will quote 95,000, another one will submit their bid for 100,000, another one for maybe they feel the TV set is worth 80,000. And then what will happen is the seller of that TV set, of course, you want to maximize and get the best price you can. So you'll find you're accepting 98,000, meaning there's a discount of 2,000. The opposite would apply in case of a premium, whereby the bidders have bid more than the face value, probably attaching the value of that TV, or maybe because there's competition in the market and people don't want to miss out. For par is straightforward. It's 100 for 100. Yes. So once the auction is done, usually I think the auctions are done on Wednesdays. So an average price is usually arrived at after that auction, which means, and maybe this is where I should have started, when you're placing your bid, there's an option either to quote, I mean to put a price that you're expecting to receive. You either put a competitive bid or a non-competitive bid. A competitive bid is where you quote a rate. And this one is ideal for people who have been following the market. They know where the rates are, and therefore they're able to tell for a 6.5-year bond, I expect it to yield an interest of, say, 15%. On the other hand, if you've not been following the market, it's safer for that investor to place an uncompetitive bid. And the advantage for this is if you've not been following and then the market is around 15 and you quote 17%, you find that the issuer, in this case, the government, will only accept up to 15%. So your bid of 17 is rejected and therefore you miss out on that opportunity. On the other hand, the market may be at 15, but since you're not aware where the market is, you quote 10%. What happens in that case is that your bid will be accepted, but you end up paying a premium for that. So you find that you have lost based on maybe lack of information that you didn't have, as opposed to the guys who have been following the market. Therefore, it's always good, maybe at beginners level, or people who have not been following the market, to place a non-competitive bid. If we go to the redemption structure, the 6.5 year bond that we are looking at here, the tenor, the face value tenor is 6.5, but we find it has some redemption structure, meaning you see there on 10th May, there's 50% amortization of the principal, and then on May 29th, 7th May 2029, 30%. What this means is on 10th May 2027, I think that's about 3.5 years from the time of investment, 50% of your investable amount, or the amount that you have invested, will be redeemed or returned to you. Therefore, you remain now, if you had invested 100, this is just for hypothetical example, because we'll go down there and look at the minimum amounts. If you had invested, let's pick a million bob, 50% of that is 500. So 500 will be paid to you after 3.5 years. So ideally, you have invested 500K in a 3.5 year, but earning the coupon of a 6.5. Yeah, so you see that's an advantage in itself. Then the balance will go on until May 2029, when 30% of that will again be redeemed to you, and the balance will continue up to maturity on 6th May of 2030. But there is a catch to this. If you look at amortization, there is a statement there saying any amount up to $1 million per CDS account will be amortized on the first amortization date. So for guys who are investing up to $1 million, the advantage is that they are investing for 3.5 years, but earning the coupon of a 6.5. For guys above an M, then the amortization structure will kick in, where if you've invested 1.1 or 1050, because the minimum amount is 50K and additional amounts are in multiples of 50, then you'll find that in the case of 1.1, 550 will be paid to you on the first amortization, and then the rest of the amortization structure kicks in. So we move on to the left. I touched on non-competitive bids, competitive, the bids closure, the auction results, and then there's an interesting item there on defaulters. So what this means is if your bid was successful, remember, this is in the case of a treasury board, this is money that has already been planned for. So whenever they go to the market to raise 50 billion and they get the 50, they've already planned for that. But in some cases, you'll find that some people who are successful do not pay up, maybe either because they had challenges with sending the money, or maybe change of mind, and therefore they become defaulters. That's the one they're saying. A defaulter may be suspended from future participation in auctions. Therefore, it's always good to either, and with the new DAO CSD, it's good because I've seen you can cancel your bid before auction if you change your mind. And the negative side is if you default, I think 3 times, then your account is flagged off and you may not be able to invest. In terms of issuance, if we go to the extreme right, treasury board issuance types and auctions, we see there are three types of auctions. There's the original issuance, reopening, and a tap sale. So original issuance is just as the word says, is issuance of a bond for the first time. For example, the bond that we have on the screen was first issued on 13th of November 2023. Yeah, and then there were results to that effect. I think the weighted average coupon was 17.9. So that one is issued and closed. But if in future we want to re-offer that bond to the market, then that the features of that bond remain the same apart from the payment date. Yeah. And therefore, for reopening, people are given a chance to put in their bids without a uniform price. As in, if we have 100 people bidding, each of them can bid their own price, the ones who are bidding competitive, and then that will be used to derive the weighted accepted price for that auction. For the tap sale, what it means is, for example, again, the case on the screen, if this, and I believe it was, if it was re-offered to the market, but at a certain price, which is the price that was discovered at the original issuance. So everyone comes in at the same price for a tap sale. Okay. I think I've captured the most crucial components for the prospectus, and maybe we can briefly touch on the investment strategies. Yes, so for strategies, there are various strategies that one can adopt for investment in bonds. There is what we call the passive investment strategy. There is the active investment strategy, and then there is the indexing and immunization. But the last two relates more to corporates. So I thought maybe we can, for beginners, we start with these two: passive investment strategy and the active one. The passive ones, just as the word suggests, means that the investor buys and holds that particular security up to maturity. In the case that we were just looking at, the 6.5 year, so if an investor buys that bond, they sit back, enjoy the coupon payments until maturity. So you don't have to worry about whether you want to sell it and maybe use that money to buy the offers that are being currently offered in the market. So you just sit and wait. Further to that, an investor may adopt what is called a laddering approach, which means you're breaking down your, let's say you have 2 million and you want to break it or stagger it so that you have regular income, but at different dates. Yeah, you can even have, based on the capital that you have, you can stagger or ladder your portfolio such that every month there's a coupon payment coming in. So you have a regular income flow for the 12 months, which is just like having a salary. Yeah, the advantage of this strategy is that you have predictable, steady income, and there is no stress of hustling the investment banks or the brokers to sell or buy for you the security. And again, because you know when these incomes are coming, remember each board has an income stream every 6 months. So that kind of gives you liquidity assurance based on the portfolio that you have invested in. The other thing is, for example, like now we are in elevated rates environment where the interest rates are a bit high. So if an investor adopts this strategy now, and then in future the rates go down, let's say fall to levels of 12, 10%, the investor is left enjoying the interest rates payable at 17% going into the future. So this strategy may be good, especially when rates are good, are high, and also for liquidity management. In the interest of time, we can quickly move to the next strategy, which is active investment strategy. And what this means, the next slide, is just as the word suggests, is that you're actively involved in monitoring your portfolio so that you can take advantage of, interest rates movement. And there are two sub strategies for this. One of them is called the bullet strategy. And what this means is you buy several bonds, different bonds, but with maturity falling on the same date or the same period. It doesn't have to be maybe on the same date, it could be within the month. So that, for example, if you have some money that you want to invest to implement a project in future, maybe 3 years to come, you can adopt this strategy, break it down into various different bonds, but maturing within that period that you have a target on. That way you'll get the income, different incomes, but on maturity, all of it will come in and will be able now to kick into your other project. The other one is a barbell strategy. And this one involves the investor splitting their bond portfolio into short-term and long-term maturities. So you're covered on the short and on the long-term. Long-term, remember when we started, I had said the idea, usually long-term bonds offer higher interest rates, while short-term, the rates may be lower, but the period of turning it over in terms of maturity is shorter. So it kind of offers you liquidity. This is good for in case you have emergencies, then in a year, or not in a year, that you can plan for that income. So this strategy has an aspect of offering flexibility to the investor. Looking at the both strategies, regardless of the one, whether you are in active or passive, I think it's important for an investor to be alert, because even if you're adopting the one of buy and hold, if you've been, following the market, you'll know when to, when the rates are high, and then maybe you can put in your money so that you can enjoy that higher interest rates going into the future. And with those few remarks, yeah, this is the one I said you need to keep tabs on the market just to know what is happening. Asante.
Okay, wow, that was a lot. I have learned so much. This is the time whereby you can ask your question. Our speaker of the day, as you can see, is very, very knowledgeable in terms of bonds and fixed markets in general. Maybe we can go back and touch a bit on treasury bills as we wait for our viewers to share any questions that they have before we share the questions that they sent in earlier. Mr. Hiama?
Sure, thank you, Gertrude. So treasury bills, unlike T-bonds, are short-term financial instruments. And looking at our market, I'm saying our market because other markets have different, investment periods for T-bills. We have three types of T-bills in Kenya. There is the 91 days, which is basically 3 months. We have the 6 months and the 364 days T-bill. So T-bills, unlike bonds, they don't pay interest, but rather are sold at a discount. So the discount is the income to the investor. Taking an example of an investor who wants to invest 100K, based on the market rates, if we just take a hypothetical example, the equivalent price of a T-bill, which is based on a 15% interest, could be, let's say, remember, all treasuries are priced in units of 100. Yeah. So if it's 100,000 again, we are pricing it in units of 100. So you'll find the price could be, let's say, 94 shillings for every 100. So that means an investor will pay 94,000. But at the expiry of the 91 days, they'll be paid 100,000. So the difference of the 6K is the income to that investor. So there is no waiting for interest on the amount that you had invested. Rather, you paid 94, you are receiving 100 on maturity. So the 6,000 or the difference becomes your income. Like I said, treasury bills are ideally for short term. You can invest either in a 91, and this is good because it plans for your liquidity needs. If you stagger them, you may even have a T-bill rolling over or maturing every week. So that kind of gives you a window for liquidity to manage your liquidity needs, as opposed to waiting for a coupon which may stretch for 6 months or monthly, depending on how you ladder your bonds. T-bills, you find the turnaround time for the investment is a bit shorter. And just like I had said, you may find that on a normal market condition, you find that the T-bill rates are usually lower than the T-bonds. And this is because they allow or present the investor with a chance to take advantage of interest rates movement. By this, I mean, for example, if we take a 91 days, the rates are still rising. Yeah, you put your money now, in 3 months, if they are still rising, it gives you an opportunity to reinvest at a higher rate. Yeah. So when the rates are on an upward trajectory, it's good to go for the short term so that you take advantage of the incremental rate changes. On the other hand, if the rates are declining, then it's advisable to lock in your money in a higher tenor. Even in the T-bill space, you can go for the 364 because now you'll get that higher rate for the next 12 months, as opposed to investing now at 15. Your money matures in 3 months' time. By then, the rates might be 10%. So you see, you're now reinvesting at 10, but the guy who had invested in 15 for 1 year is advantaged. I think the T-bills part is a bit short, and that's about it.
Okay. So treasury bills short term, and you get them at a discount as opposed to government bonds. Okay, thank you so much. We have come to the Q&A section of this training. Our first question is, how do you evaluate bonds performance? How do you evaluate bond performance?
Thank you. I think I'll look at this from the aspect of the overall board performance. And how we look at this is based on the turnover. By turnover, I mean you can look at the volumes of the boards that have been traded as a percentage or as a proportion of the total stock of boards in the market. For example, if we are looking at the performance, maybe for boards performance for the month, we can look at if the volume was 100 million and then the stock was a billion, then you'd say 100 million out of a billion is, let's say, 10%. So if the performance rate is increasing, let's say to 20 to 30, then you'd say that the board market performance has been very liquid for this particular period. The other aspect would be to look at it from the point of the yield curve, whether it's shifting up or down. And then you remember the relationship between price and yield. So in an environment where the rates are higher, if, for example, an investor had bought during that period of high interest environment, and then the environment changes to that of interest rates going down, you'll see that the board prices are going up. So an investor who wants to sell their board at the secondary market will most likely or most guaranteed sell their board at a higher price in the secondary market. Thank you.
Okay. So you look at the turnover and the yield. The second question is it advisable to take up a loan to invest in bonds? If we take up loans to buy plots and build rentals, can this be done for bonds? And is it advisable?
Wow, that's a tricky one. I think the objective here is what matters, because if you'd like to, or you're a risk taker and you want to take a loan to invest to improve your income generation, then I think there's nothing wrong with that. But the catch here is you're taking a loan, let's say at 10%. The boards are now at 17%. So you have a spread of 7% as income, as in the difference between where you're borrowing and what you'll be earning. But remember, the board, the coupon or the cash flow from the board is on a 6-month period. On the other side, the loan repayment, I believe, is on a monthly basis. So one needs to be careful as they plan for that, so that they can take advantage of the situation. Thank you.
Okay. Thank you so much for that answer. The next question is, where do we start when it comes to buying bonds? Where do we start?
Okay, the first step is to open a CSD account at the central bank. And I believe this has been made easier now. One can open a CSD account wherever they are, in the comfort of their own house. You don't have to fill any papers. All you need to do is download the app, the DAO CSD app, and then you create your account. The application process is still online on the same app, and therefore everything has been automated. The first step, open a CDS account, and of course the second one is to have the money to buy the securities. Thank you.
Okay, you've had
maybe Gertrude, on that one, there's something I would want to add. When you're opening the CDS account, you don't need to have money at that point, because the moratorium given for CDS account is 1 year. So you can open the account now, even if you don't have to invest next month or next, as long as at some point within the 12 months you'll have invested, then that account will remain active. Beyond 12 months, it will be dormant and you have to start all over again.
Okay, thank you so much for that information. I didn't know that that specific part.
Yeah.
Thank you. The next question is, how does one leverage on the secondary market? How does one leverage the secondary market?
Yes, again, this is the one I had touched on earlier, and it's also based on the slide on the screen, whereby you take advantage of the interest rates movement. You find that like now the T-bonds prices are a bit low because of the higher rates environment. So one can buy now at the secondary market in anticipation that the rates will go down and then the prices will go up. And then there's an opportunity to make money at that front.
Okay. I believe these are the questions you've covered. However, let me just read them out. Will you be covering investing in people, and how can one start, and the risk reward for this since it is short term? Maybe in summary, you can answer that.
Yes, I believe we covered the T-bills earlier, but if maybe that person had not joined in, the process for investing in T-bills is pretty much the same with the bonds. The first step is to open a CDS account or CSD account at the central bank. The tenors are 91, that's 3 months, 6 months, and 1 year. Minimum amount to invest has been reduced. Now it's 50K. It used to be 100K, and any additional amounts are in multiples of 50,000. Remember, T-bills are short-term, and therefore, in terms of liquidity, they offer the investor an opportunity to, manage their liquidity because the turnaround time is shorter as compared to bonds.
Okay. Our last question for this session is, can bonds be bought from private entities?
Yes. Remember, we said that the first step is to have a CSD account. And those who can open a CSD account is you can open individually, jointly, registered chama, private entities. And again, there are two markets for T-bonds. You can either buy at the primary market, that's at the offers that are offered by the central bank, or you can buy at the secondary market through an investment bank.
Okay.
I hope I've clarified that.
Yes, you have. Sorry for cutting you short. So you can either buy from the primary market or the secondary market with the assistance of an investment bank. I believe that's it for this session. I have learned so much. I have taken so many notes, which I'll be reviewing. Thank you so much, Mr. Kiama, for joining us. I hope that you can join us another time for another session. Maybe we can go deep into the intricacies of financial markets.
Thank you, Gertrude. It's been a good, presentation and to share with you guys. I believe even as the questions that might come later, you can reach out. I'll be happy to answer them. And for those who have learned something, share the word. And let's empower each other. Thank you.
Welcome. One thing that Mr. Kiama did not mention is that he works at CBK. Therefore, as an investor, he's an investor, you have access to the best, and I believe we can reach out to you for assistance. Mr. Kiama, how can we get in touch with you?
I think I'll share the contacts with you behind the tent. Yeah.
Okay. From our participants today, would you like to say something? Maybe something that has stood out for you? This is your time before we end the session. Would you like to say something to our speaker? And yeah. I believe that's it. Thank you so much for joining us. To our speaker, thank you so much for sharing this knowledge with us. And I believe we'll see you next time. Have a great December holiday. Bye.
Happy holidays. Thank you.